Hello and welcome to the download. I'm your host, Dave Richardson, and it is always a special episode of the download when we can connect with Laurence Bensafi. Laurence par excellence, comme on dit quand on était à Londres. Laurence, how are you doing?
I'm all right. I'm pretty good, actually.
I would imagine so because here's the thing. I'm a big believer in emerging markets, and of course, Laurence is and her colleague Phil Langham are the leads on the emerging market team at RBC Global Asset Management. And despite all the opportunities in emerging market for a number of reasons, which we've talked to on previous episodes where we've had Laurence or Phil on as a guest, the emerging markets have lagged behind the U.S., lagged behind some other developed markets, but all of a sudden, boom! We get into 2025 and we look at the first half of the year, and we're doing a series right now, Laurence, where we're talking to people who are managing different geographies, different types of asset classes, and looking back at the first half of the year, looking forward into the second half of the year and beyond, which is really what's the most important. But all of a sudden, emerging markets have been and again, emerging markets is always tough because there's how many emerging markets how many countries are categorized as
I
emerging
mean,
markets now?
technically, we've got about 25.
25. So not all 25 fall into this category, but when you aggregate them together, emerging markets are the top performing asset class in stocks, it's top performing area of equities around the world in the first half. And I guess as you sit there triumphantly, it's about time. But what do you think? What do you think finally
Yeah.
kicked off this big rally? What did people finally see that we've seen all these years in terms of the opportunity in emerging markets?
Yeah, I think you're right. We've been saying for several years now that, we do a rebound in emerging market, that emerging market has been underperforming for too long developed markets. And that didn't happen for quite a few years for a lot of different reasons that we mentioned through the years. One of the biggest one being the very strong US dollar. And the fact that there was this belief that, US equities is where you want to be because they're doing well, the US dollar is adding to your performance. So why changing, anything on that? And I think we've been always saying that the valuation were attractive for emerging market. There's a lot of interesting countries. The positioning is pretty low. So everything was there for a kind of a rebound, a change of leadership. But we always said at the time, I remember saying, look, there would be something. Usually you've got a change in leadership when something happens. There's a big event. Last time we had that was actually the global financial crisis, is when the US really started to dominate, I would say, and the US dollar started a very long period of strengthening. So we said, look, it's going to be something like that. But by definition, we don't know what it is. We don't know when it's going to happen, but it would happen at some point. So now when we're going to look back, we're going to say, yeah, it was Donald Trump election, which, to be fair, no one would have thought that would have such a big impact, because if anything, I think going into the elections, the market were a little bit more positive about Trump coming into power. He's very, business friendly. It's going to be good for the US, for the economy. But basically what happened is that quite shortly after he started his presidency, I think it's, look, we can talk about it for hours, but I would say it surprised the market, I think, with the tariffs. That was really, I think, the turning point. So those tariffs were badly received, to say it mildly, by the market. And I think why is because at the end of the day, they highlighted that maybe the US economy, some of the weaknesses were highlighted. I think first it was highlighted that the US, and we knew it, but people realized that maybe now, that there's a lot of debt in the US,
Yeah.
and your creditors are a lot of emerging market countries such as China or others. And if you upset them, maybe there would be repercussions for you. So that was one. The other one is that actually Trump, and he's backtracked, as you've seen many times already. Now he says the 1st of August and that's it. But, he said that already quite a few times. So I think the fact that he's been backtracking also, I think investors have realized that, yeah, the US economy definitely is strong, but there are other strong countries other superpowers. And I remember talking about that, before. The world has changed. It's really new superpowers. China has been for a while, but India, Saudi Arabia, the Middle East, those people have some power as well now. And there's been a lot of discussion back and forth, and it's not obvious that the US will get what they want. So all that made a situation where the US dollar finally started to weaken. And I think that was the turning point, is when you have a little bit of worry about the US dollar and thinking, okay, what's going to happen in the next, years? And, it's a bit of self-fulfilling, is that when the dollar gets a bit weaker, some people think, okay, maybe I'd rather put my money somewhere else, and they take money from in US dollar, and etc. So you're right. What you've seen, and I talk to a lot of clients outside Canada, in the US or in Europe, and everyone is thinking, or is starting to move money outside of the US and into Europe, and emerging markets are obvious candidates.
Yeah, we had Andre Skiba on the podcast yesterday, and one of the things that he talked about, and we've been talking about a little bit, and I think we've even had when we've had
Yeah.
conversations on the podcast before, one of the sort of behind the scenes whispered policy out of the U.S. When up front it's America first, it's one big beautiful bill, it's economic growth, America as the world power, but behind this, underneath, it's to make everything work, we need a weaker U.S. dollar. And this was something that we had kind of anticipated happening. I know many of our
Yes.
guests on the podcast, and then sure enough, Trump's elected. We start to see and get a better understanding of what the policy regime is going to be, including tariffs, and then. And it had already kind of started once U.S. rates had peaked in October of 2023, that the U.S. dollar started its drift,
Mm-hmm.
and then it's accelerated since Trump's been in office. Against on a dollar index basis, we've seen the dollar pop back a little bit over the last couple of days, but we're down, anywhere from 8 to
Mm-hmm.
12% on the U.S. dollar against a basket of global currencies. That's a pretty big move in a short period of time. And as you say, that gets people looking to other areas of the world where there's opportunity. And emerging markets have been one of those obvious choices, because when people don't look there for a while, and they start to dig around, they find kind of
Exactly.
what you and Phil find when you're out traveling around the world visiting these different companies, that there's some amazing companies in emerging markets. There's amazing potential. And you should have some of your portfolio exposed to this part of the world, because this is where the future population growth is, and the biggest opportunity for productivity gains, and therefore the biggest opportunity for growth. Have I stolen your whole presentation?
That's it. We're done. Yeah, absolutely. No, but you're right. I think, and that's why I said it kind of backfired on Trump a little bit, because I think, for instance, China, the fact that they stood up to him, and I think now a lot more people are aware how advanced China is, and the fact that actually China can say, you know what, we'll see. We can negotiate with you, but we're not going to say yes to everything you say, and we have that power actually. And on China is one of the first country when Trump went very quickly to try to negotiate, because I think China can hurt more the US than the US can hurt China. So you're right. Is I think a lot of people realizing that actually there's a lot of potential in emerging market. There are great companies, and the valuation support is here as well. When you start to look at it and you look at how little you pay for that, and I think a good example is what happened in Korea, for instance. So Korea has been on fire. Is the
Yes.
best performing of our big country this year. Is at 40%. It was a bit of a forgotten country, I would say. And then you had a change in government, and a few reforms have been announced, a little bit like what happened in Japan
Yes.
recently. And suddenly everyone is like, wow, that's actually a fairly interesting country at super, super, super low valuation. And then you've got, value creation, and people get excited. So I think Korea is a bit of an extreme point, but that's how people, I think, are looking at EM now. Exactly what you said. It's been ignored for so long. And then when you start to look at it, you're like, wait, same way as Taiwan has been doing well, because you have all the suppliers for the AI value chain, and they trade at a fraction of what you would pay for the US company. So some of those names in Taiwan and some we own in our portfolios have been flying also recently. So yeah, definitely a lot of good things that people are coming back finally. So we're quite happy with that. And to your point on the US dollar, I think the ideal scenario for everyone, you're right, the US wouldn't mind a weaker dollar. I think it's just, it cannot go down too quickly. It cannot depreciate too quickly or too much. But if you have like a gradual depreciation over the next few years, that could work for everyone, right? Because that would make US export more competitive. That would make emerging market countries for which the currency were maybe too cheap, they can import a little bit more. So that's going to rebalance a little bit the economy. For asset class, it's really good. It's really positive for the asset class. So I think that could be this kind of environment we're looking at for the next few years, which would be very positive for EM for sure, but not necessarily negative for the US as well.
Yeah, and Canadians can sort of remember in Canadian US dollar terms. It's often said that the one number that any Canadian can quote you, Laurence, and I know you're over in the UK, and you're born in France, but if for Canadians, it is the Canadian dollar US dollar exchange rate. I can walk up to pretty much anyone on the corner of the street here in Canada and say, "Where's the Canadian dollar today?" They don't even think of it as it's a dollar. They'll go 73.5 cents US. They can nail it usually to a decimal point, sometimes even 2 decimal points. And so Canadians will remember the period from about 1999 through to past more like 2000 to 2011, where the Canadian dollar went from below 70 cents and rallied up to, at one point, was at $1.10 US for very briefly, but sat above parity for a little while. And it was at that same time that the US dollar wasn't just weak against the Canadian dollar, but it was weak against all global currencies. And it's through that period that emerging markets really were the place to be from an investment perspective. So not surprising as you see the US dollar roll over again, that you're starting to see the same kind of outperformance occur again.
That's it.
And so Laurence, is there any, so you talked about Korea, Taiwan, and again, you've got 25 different markets as you say that you're looking at. Korea and Taiwan are more, they tend to be markets that do well as the global economy is doing well. They've got that technology focus, which has been a big part of driving US and developed markets as well. Is there a characteristic to the types of markets that are doing well, or are you seeing across the board those emerging markets, even ones that are more, say, commodity related? Are they doing as well, or is this a winner and loser? And how are you going about determining where you want to be within the different emerging markets?
Yeah, so because we are in a bit of a new environment now, which is a bit of a change from quite some time, right? Where you have dollar weakening, appetite coming back a little bit for emerging market. What we've seen more of the riskier parts of the market that are doing better. So, for instance, what has been doing really well as well this year is Latin America, which has been, again, the biggest loser of the environment we were until recently, right? So Latin America really is now a very small part actually of our universe. It should be a lot bigger when you think about Mexico, Brazil, I mean, big countries. But Latin America in our benchmark is about 7%. I mean, it's tiny. It used to be more than twice that easily. So what we've seen since the beginning of the year, really a return to Latin America, which we were positioned for. It was one of our call at the beginning of the year, thinking that really Latin America was trading at the lowest valuation. People were worried about the trade war between Mexico, obviously, and the US. In Brazil, you've got like a populist government that is spending way too much money. and so there was a lot of worry, and they had issue in Chile, in Peru, in other countries. And really what we've seen, we were very pleased to see that actually with this new environment, we've seen really a return to Latin America, with very strong performance from those markets. They were, I mean, if you look at Mexico, Brazil, Chile, they're all up about 30% in US dollar this year. So very strong performance. And we're still positive on them, I would say. We've got a very good president in Mexico. I know she's been negotiating with Mr. Trump with quite success. We think they're going to renegotiate the U.S. The Mexico the trade agreement,
Yes,
right?
yeah, USMCA. Yes.
USMCA, that's it. Should be renegotiated successfully soon, hopefully. And Mexico has a lot to offer still. They underdeveloped countries. So we like the financial sector, for instance, or the food retailer sector. Brazil is interesting. We're going to have elections in a year, and it's always a big, big deal. And people are already starting to be excited if you have a return to more business-friendly type of government. Chile has election at the end of this year, actually, same story. So LATAM is still an area we like, and I think it's more like a risk-on environment type of country, and could continue to do well. I would say something that has been doing a bit less well recently, and I remember we flagged it a little while ago, is India, which
Yes.
remains an amazing story. And we've got obviously good exposure in our portfolios, and we encourage people to have good exposure. But if you remember, about a year ago, we had highlighted how expensive India was. And India benefits a little bit less from this, suddenly India is a lot more domestic story, and the domestic has been a little bit weaker in India, where growth has disappointed, and because of really high valuation, there's been really like a bit of, I would say, people waiting a little bit on India. So I'm not saying India, again, medium, long term, we're very positive India will do well, but in that environment, it's not necessarily going to be the country that's going to perform the best, I would say. And finally, the big question mark is still on China. So
Yes.
China remains, has done not much. I think people are waiting to see more evidence, even though the government, I think, have said a lot of the right thing to say. They're focusing on the private sector. The issue is China is that even though there's often a good growth, I mean, good economic growth, GDP growth, it doesn't translate into EPS growth. And that's what investors want to see, obviously. So the question mark is there. Yes, they're going to stimulate the economy. Yes, they want to reform, the manufacturing sector. They say the right thing, but it needs to translate into EPS growth, and that's when China is going to do well. But I still think at this level of valuation and potential for improvement, it's not a bad place to be as well.
Now, I was looking at some of the different portfolios that you and Phil manage, and I noticed that the small cap portfolio has done very well, and the dividend portfolio, which I know is very specifically your area of expertise, is doing particularly well. Why are dividend stocks in emerging markets doing so well? And is there a particular sector or sectors in that space that have been particular winners and that you've been able to tap into to drive performance?
Yeah, so we would have expected small cap and dividend / value. We have a value tilt to do better in that environment, because you have a market that is up like 17% in a few months, which is quite a good performance. Risk appetite coming back, and in that dividend strategy, and the same as the small cap, we buy stocks that are a little bit more, I would say, punchy. That are they can do very well when they tend to be quite cheap. And they can be a bit more volatile. So when things, align, they tend to do very well. And that's what happened in that portfolio and in the small cap as well. I guess our core strategy is a lot more, highest quality names. You protect very good protection on the downside. And obviously we're not in that environment, even though the portfolio has been doing well. I mean, it's been keeping in line with the benchmark, which is, as I said, about 17%. So you get that exposure. But I think in that kind of risk-on environment, the dividend would tend to do better. It did what we expected to do. So we're quite pleased with that.
Yeah. Now Canadians, again, if I bring it back to Main Street here in Canada, it seems like there's a bank on every corner. Canada has a very a distinct banking culture and banking environment, and the bank stocks have a particularly strong presence in the Canadian market as a dividend payer. Are banks in emerging markets? What's the opportunity there? I know when I've been with you and Phil, I
Yeah,
think Phil was talking specifically about a Peruvian bank
yeah,
that you'd invested in,
yeah.
and then just talked about the market activity again. Like every Canadian just takes for granted, oh, we have a bank account. But in the rest, in the emerging world, it's not exactly like that. It's an underbanked area. Maybe you could touch on that.
Yeah, and it's a great question because I think financials, so banks and insurance in particular, are an area which is one of our favorites, where we tend to have always quite a lot of exposure. And it's very interesting because it's exactly what you mentioned. On one hand, it's quite underpenetrated, not in all the countries. I mean, Taiwan, Korea is penetrated, but like
Yes, yes.
Mexico, 50% of the population doesn't have a bank account. Same in Indonesia. In India, they have bank account, but everything which is mortgages, credit card is very underpenetrated. So you've got a massive story of underpenetration for billions of people, basically. At the same time, those banks and insurance went through hell quite a few times in emerging markets, different
Yes.
crises, etc. So the surviving one tend to be really good. And when you look at them, they actually make a lot of money. They know how to manage. They know they need to have a strong deposit franchise. They cannot rely on, on external funding. So they tend to be quite profitable. It tends to be relatively concentrated in quite a few countries. So they make money. They pay a lot of dividends.
Okay.
And they're growing, but despite that, they're cheap. So it's a bit of the perfect area to invest in. You still have to be selective. Obviously, I'm not saying you can buy any of them, but in a lot of countries, so you mentioned Mexico, Peru, Indonesia, Philippines, India, in those countries, you can really find really high quality bank growing, paying really high dividend yield. So, you mentioned that bank in Peru, but plenty of them would have like 5, 6, 7, 8% dividend yield, even
Wow.
higher in some countries. And for growth and profitability. So we like that sector quite a lot. We like to be diversified. So we have, in all different countries, but for us, it's a very long-term penetration story with quality names.
And I'm going to ask. I should never ask a question that I don't know the answer to, but I'm going to ask it right here. Most of those dividends from those banks in emerging market countries, they would be paid out in the domestic currency, correct? Or would they pay out in
Yes.
U.S. dollars?
No, they paid in domestic.
So again, once again, the U.S. dollar weakness,
It's good. Mm-mm.
and then the relative strength of those currencies helps
Yeah,
the value of
absolutely.
those dividend payments
Yeah,
as they come out. Whereas in previous years,
it was
if
the
I
other
get
way
my
around.
yeah, I get my dividend in pesos, and
Yeah,
I bring it back home, and
yeah,
I'm not as happy about it. I know my dad lives down in Mexico. He likes his peso dividends, but bringing them back to Canada hasn't always been the best thing. So that that
absolutely.
that's a phenomenal story. So Laurence, again, so we've talked a lot about where you're looking, what's been good. Is this a story now that carries through the second half of the year, or maybe even longer, now that you've had that switch flipped, which was the Trump election and all the discussion around tariffs, the weaker U.S. dollar? Is this a story that can last a little bit longer, and is it something that investors should be really thinking about? Because I'd argue that most investors are probably underweight emerging markets.
Yeah, I mean, look, we think so. We think that those, you tend to have long cycles in a US dollar, long cycles in performance in kind of region. So US as US economy, US stocks, US dollar has dominated for a while. Now we're entering an area where there's a lot of debt in the US, even more is coming up. We don't know what's going to happen with inflation. We don't know. I mean, there's a lot of uncertainties in the US. And on the other hand, you've got Europe that seems to have a bit of a new purpose now. Emerging markets that's also been, I think, you can see the benefits now or the strengths of a lot of those countries in EM. So yeah, as I said, I think if we imagine an environment where the US dollar kind of depreciate again, little bit by little bit, so maybe 10, 15% this year, maybe another 5, 10 next year. This kind of, you don't want to crash. I think crash would not be good. But
Yeah,
if you
yeah.
see this kind of environment, then we can continue to have basically the way you can look at it is that between EM emerging market and developed market, and mainly the US, the discount of valuation on the equity market is about 50%, right? It's the highest it's ever been. When you were talking about the top in 2011, it was EM was trading at a premium, if you believe it. So it went from trading at a premium because people were paying for superior growth, right? So we went to trading at a premium to a 50% discount, which has never been in the past. So, I'm not saying we're going to necessarily go back to a premium, but even though you have like this discount to close to, I think a normal discount should be about 20%. That's still a lot to go, basically. But we'll have to see, because the world is so uncertain, geopolitical. There's a few wars around the world. The US remain, an area that people favor. But I think it's more about being diversified and not having everything in one basket, and making sure that is diversified across. So EM has definitely a place in a portfolio, I think, considering the potential for growth and the quality of the corporates we invested in particular.
Yeah, and that's such an important point. It's about diversification. As we were saying last year, when a lot of investors were coming up and talking to me, and I know you, when we would be out traveling together, why don't I just invest everything in the U.S.? Why don't I just put 100% in the U.S.? And that's never the right answer. Just like selling all your U.S. right now is not the right answer. But same thing, emerging markets performing well. This is not Laurence even. And myself too, as emerging market believers, we wouldn't say put 100% of your portfolio as a Canadian in emerging markets, but it's good to have some exposure, and that could be through a portfolio that's managed by someone else to determine that right ratio, or with your advisor. But emerging markets where we're sitting today certainly merit for any Canadian portfolio some exposure for you to take advantage of the potential that these areas have. And again, as you say, hey, 50% off, a 50% discount to American stocks, that's got to be attractive. When I see something that is on sale, that's when I start to get interested in it. And again, if I wait, if I'm patient, eventually that fair value is going to be shown. Again, even if it ends up being at a little bit of a discount for good reasons over the long term, a 50% discount seems a little low. So it's nice to see. It's nice to see emerging markets some life in them again. Especially for those who follow that diversified discipline and have that exposure. But you and Phil the Thrill, Laurence par excellence. They don't have those nicknames for no reason at all. They're about the best there is. And Laurence, it's so nice to see a big smile on your face with things going so well right now. And congratulations on the first half of the year.
No, thank you, and let's see what where we catch up again at the end of the year. But hopefully, the trend will continue. Yeah.
Well, thanks for your time, and hope the family's great, and we'll hopefully see you soon.
Thank you so much.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only, and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.